Hey there, and welcome. Today, we're cracking open the Investor's Toolkit. We're going to look at 4 really powerful ratios that'll help you get way beyond just the sticker price of a stock to see what it's really worth. So let's get right into it.
It's the million-dollar question, isn't it? You see a stock price flash across the screen, but what does it mean? Is it a total bargain, or is it wildly overpriced? And look, it's one of the biggest hurdles for any investor. But the good news is, you don't have to just guess. There are tools designed to help you figure it out.
All right, so here's what we've got on tap. First, we'll tackle that big question: what's a company worth? Then we'll dive into the most famous ratio of all, the PE. After that, we'll see what to do when earnings just don't tell the whole story, and then we'll look at how to value a company's physical assets. And finally, we'll put it all together into your complete investor toolkit.
Okay, so before we just jump in and start using these tools, we got to understand what they actually are. Financial ratios come in a few different flavors, and each one tells you something totally different about a company's health. You can think of financial ratios like different families of tools. You've got ratios for things like liquidity or profitability, all super important. But today, we are zeroing in on one essential category: valuation. What these ratios do, and this is the key part, is tell you how much stuff, like earnings or assets, you're actually getting for every dollar you put into a single share.
All right, let's kick things off with the undisputed heavyweight champion of valuation ratios, the price-to-earnings ratio, or, as you'll almost always hear it, the PE ratio. If you've ever glanced at a stock quote, you've definitely seen this one.
So what is it? Put simply, the PE ratio answers one really basic question: how much are people, the market, willing to pay right now for a company's profits? It's a direct face-off between the stock's price and its earnings.
And the math behind it? It's beautifully simple. All you do is take the current price of one share and divide it by the company's earnings per share, often called EPS. That's it. Price divided by earnings.
So what does the number actually tell you? Well, a really high PE, let's say over 25, usually means that investors are super optimistic. They're expecting big growth in the future. On the flip side, a low PE, maybe under 15, could signal a potential bargain. Or it could be a red flag that the company's in trouble. Context is absolutely everything here. Okay, let's make this super concrete. Just imagine a company out there whose stock is trading for $50 a share, and over the last year, they earned $5 for every one of those shares. You run the numbers, 50 divided by 5, and you get a PE ratio of 10. Easy, right? But the real question is, what does that 10 actually mean? And that is the key. A PE of 10 means that for every single dollar of profit the company makes, investors are willing to pay $10 to own a piece of it. This gives you this incredibly powerful benchmark to compare that company to its competitors or even to the entire market.
But what happens if a company doesn't have any earnings to speak of? Or worse, what if their reported earnings are kind of fishy because of some accounting loophole? Well, that's when the good old PE ratio starts to break down, and we need to reach for a couple of different tools in our kit.
And this brings us to a really crucial point: reported earnings. They aren't the same thing as cash in the bank. You see, a company's official net income can get pushed down by all sorts of non-cash accounting items like depreciation. But cash flow, that just tracks the actual money coming in and going out. It's often a much purer sign of a company's real financial health.
And that leads us right to our next tool, the price-to-cash flow ratio. This one cuts through the accounting noise and gets right to what matters for a business to survive and grow, that cold, hard cash.
The formula is just as simple. You take the price per share and divide it by the cash flow per share. Typically, a lower number here is better. It kind of suggests you're getting a healthy stream of cash for a cheaper price. It's a fantastic sanity check to make sure a company's profits are actually backed up by real money.
Okay, but what about that hot new tech startup that's pouring every single cent back into growing the business? They aren't profitable yet, so their PE ratio is totally useless. This is where the price-to-sales ratio becomes your best friend. It ignores profits and just compares the stock price to the company's total revenue, its top-line sales.
Again, the math is simple: price per share divided by sales per share. A low PS ratio could mean a company is undervalued compared to how much business is doing. This is an awesome tool for those young, high-growth companies because, sales tend to be a bit more stable and a lot harder to fudge than earnings.
All right, so far, everything we've looked at has been about a company's performance, its earnings, its cash, its sales. But this last tool,
It takes a totally different angle. It tries to value a company based on the simple, raw value of all the stuff it owns.
This is the price-to-book value ratio, or P/BV. Think of it this way. It gives you an idea of what a company would be worth if you just shut it down, sold off all its assets like buildings and inventory, and then paid off all its debts. That leftover value is its book value. It's basically the company's net worth, right there on the balance sheet. And the formula? You guessed it, price per share divided by book value per share. Now here's the really interesting part. If you ever see a PS/BV ratio that's under 1, it could be a sign that the stock is actually trading for less than the paper value of its assets. That could be a huge bargain.
Now, this ratio is fantastic for industries that own a ton of physical stuff. Think banks, manufacturing plants, real estate firms. But, and this is a big but, it has a major blind spot. Think about it. For a company like a software giant, its most valuable asset is its code or its brand name, right? Well, that stuff doesn't really show up on the balance sheet, which can make this P/BV ratio a bit misleading.
Okay, so we've got our 4 tools, and here is the most important part. You never, ever use just one of them by itself. They're like different instruments in an orchestra. Their real power comes when you use them together to build a complete 3D picture of a company's real value.
Think of it like a little checklist. You can start with the PE ratio to just get a quick read on what the market is thinking. Then use the PCF ratio as a reality check. Are those earnings backed by actual cash? If the company isn't profitable, then you pivot to the PS ratio to check out its growth. And finally, you can use the PBV to get a sense of the company's asset value as a potential safety net. It's all about looking at the same company through 4 different lenses.
By looking at a stock's price from these different angles, from earnings, cash, sales, and assets, you're moving past just staring at a stock price and starting to actually understand what's behind it. You now have the essential toolkit. So, the only question left is, what's the first company you're going to analyze?